For the average earner, taking on debt means financial stress. Yet for the ultra-wealthy, borrowing money is the mechanism to safely accumulate more capital. Standard loans are structured around a specific mechanical disadvantage. They are typically used for things that lose value over time, like cars or electronics. Worse, these loans are serviced with after-tax income, meaning the government takes its cut before a single dollar goes towards paying down the bank's interest. Because your ability to repay relies entirely on a single job that could disappear tomorrow, banks see you as a risk. They price that uncertainty into the loan up front, applying high interest rates and strict monthly repayment schedules. Without assets that grow in value to balance the scales, this structure forces regular people to effectively rent their lives from lenders. Consumer debt mathematically limits your financial progress. The wealth playbook begins with ownership, specifically of assets that tend to increase in value, like real estate portfolios, public stocks, or private businesses. Having a portfolio changes the entire relationship with a lender. When a high net worth individual walks into a bank, the bank stops evaluating unstable job income and starts looking at a rock-solid balance sheet. If you own $50 million in assets, you don't ask the bank for a $50 million loan, you ask for $10 million. This is called a low loan-to-value ratio. By borrowing a tiny fraction of their holdings, the transaction is practically risk-free for the lender. Because that massive pile of collateral completely covers the bank's downside if anything goes wrong, the lender is thrilled to hand over the cash. In exchange, the wealthy borrower gets rock-bottom interest rates and total loan flexibility. The primary incentive for this strategy is that borrowed money is not legally classified as income. By taking a bank loan instead of a standard salary, the rich access millions of dollars in spending power completely tax-free. This chart details how these asset-backed loans are structured. Notice that the borrower is never forced to pay down the principal amount month to month. Instead, they just pay a small annual interest fee, leaving the massive loan balance untouched until the end of the term. So what happens when that 10-year note finally comes due? They simply extend the timeline. Instead of selling off their holdings to pay back the $10 million, they take out a brand new loan to close the old one and continue paying only the interest. Handing millions to a bank in interest fees sounds expensive until you run the math on the alternative. Selling off assets to generate that much cash would trigger immediate capital gains taxes. Paying a low interest rate to a bank is often cheaper than paying the IRS. Plus, while they were paying those small interest fees, their investments kept growing. Over a decade, that original portfolio likely doubled in value. Now they can borrow even more money against that expanded wealth in the next cycle. This creates a cycle of sustained spending power that keeps the underlying portfolio intact while perpetually bypassing the tax system. Borrowing against your assets for decades works beautifully while you are alive. But what happens to that mountain of accumulated debt when the borrower eventually dies? Logically, the heirs would have to sell off the family assets to pay back the bank, and selling assets that have grown enormously over a lifetime should finally trigger a massive capital gains tax bill. This graph shows an asset growing from $1 million to $10 million. Thanks to the step-up in basis tax rule, when the borrower dies, the purchase price legally sets to the current market value. The system pretends it was always worth $10 million. Because this accounting reset erases the $9 million profit record, the heirs owe zero capital gains taxes on that growth. Now, the family sells a tiny fraction of these untaxed assets. They pay off the original bank loan, keeping the massive remaining surplus intact. The rich don't just use debt to fund their lifestyle. They use it to ensure all their assets pass to the next generation without being diminished by heavy taxes. It transforms a common debt trap into a brilliant method for protecting an inheritance.